It's not businesses that fail all the time. It's people.
Your network is your net worth. Come listen to some of the most successful people I know share invaluable knowledge, stories, and advice in real estate, business, and beyond. This is Weiss Advice. Whether you want to take your business or personal life to the next level, look no further. Welcome back to Weiss Advice. I'm your host, Yona Weiss. It is a pleasure to have you joining me today, and I'm very happy to have my friend Ivan Barratt, Barratt Asset Management, on with us today. It's a beautiful day. Looks like you got the office. I can't tell if you've got the it's a green screen office in the background or that's really your office, but it looks nice.
That's me. It's all me back here. No green screen.
That's beautiful. That's great. So a little bit about Ivan. You know, he's a multifamily owner, syndicator. He owns a large management company, Barratt Asset Management. Okay, BAM. All right. And, you know, over 3,000 units. He's raised over 80 million in equity. Currently, his portfolio consists of over $300 million of assets under management. So I remember about a year ago, Ivan, that your firm was featured in Indianapolis as one of the fastest growing companies, not just real estate, fastest growing businesses in the city of Indianapolis, which is a true feat into itself. So congratulations on that. And I'm sure since then,
thank you.
Even with the current environment of the economy, you guys are still growing.
Yes. Yeah. It's been fun. I just got word we hit the top 25 fastest growing companies for the second year in a row. I think we'll hit the Inc. 5000 for the third year in a row. And it's been fun. This year, we seem to be growing a little bit faster than we did even last year, which last year was sort of a slower pace, not for lack of capital or for lack of want, but for lack of good deal flow. And before I forget, dude, it is good to see you and hang out for a little while. It's been several months.
Yeah.
I think really my last road trip for business was Rod's event in LA and got to hang out with you a little bit there and chat. And it's good to see you and hope I can deliver some good value today for your audience.
Likewise. Yeah, that was an awesome event. In fact, I had Rod on here. It was a little nostalgia for him because that was his last, also, basically everyone's last event, but that was his last big event. But that was truly an awesome Rod Cleave's boot camp in January. That was an incredible event. And it's always a pleasure to see you. I think we were supposed to be sharing a stage again in Chicago like a couple weeks ago at John Kasman's event, maybe. I don't know. I think that was canceled as well or postponed. So,
yeah, unfortunately.
But yeah, thank you for joining us. And tell me a little bit about that because it's really intriguing. Obviously, people were talking about how, the past few years in general, the multifamily market has been kind of tightened, harder to find good deals. But it sounds like now in this environment, it's I wouldn't say easier to find good deals, or they're just more available or less players. What are those factors?
The short answer is yes. I feel very grateful to have a track record, a team in this environment, and some great relationships with owners and brokers. When this all started going down, we were in the middle of pursuing an off-market deal, direct to seller with one of our broker relationships who brought us the transaction, sort of a quiet sale, older partnership, leaving some meat on the bone for the next guy, just straight down the fairway for us. And, we had to make a prediction on this economy and where it would go. And we placed a bet, essentially, hard earnest money, my partner and I, to the tune of about $250,000 hard of our own cash. We placed a bet that the economy would overreact, that this wouldn't be as bad as everybody was predicting. And a couple things would happen. Number one, that here in the Midwest, people would still pay their rent in our price point, our B+, A- price range. People would still mostly pay the rent. The Fed and the Treasury would continue to support the economy. Post 2008, there's their playbook would be opened up, and they would They would
Mhm.
stimulate as much as possible to save the economy. I've been reading up on this for a long time, and so my bet was that the Fed would not let another deflationary financial event occur to an extent like it did in 2008. And we made a bet that there would still be an availability of good debt
Mhm.
on good terms for operators like us. And so we sort of did one of these and placed a bet, and it's paying off now. We have two deals that we've achieved or are under contract to be closed later this summer.
That's great.
Both here in Indianapolis, both off-market deals. And I can tell you, if the pandemic hadn't have hit and these assets would have been on market, I think there's a high degree of probability that I would have been smoked on purchase price in the bidding process. For us, we've got a line in the sand, and great example, 2018, we wanted 2,000 units. We acquired about 800, not for lack of capital, but for lack of deal flow.
Right.
2019, same goal. Let's get 1,500 to 2,000 apartments this year. We did two, a little over 500 units. Again, not for lack of capital, but for lack of deal flow. And now here we are in June 2020, and I've got two deals in the pipeline that I couldn't be more excited to close. And it's been years since we had this sort of deal flow this early in a calendar year. Usually Q4 is where we see most of the transaction activity.
Interesting. Yeah, that's quite amazing. I mean, and it just goes to show you, I mean, you've been in this for the long haul. And so to be able to make those predictions and to kind of capitalize on the opportunities, you had to have had that experience and have gone through that beforehand. Otherwise, you'd kind of be a fool if you weren't in your situation and making those same predictions. That's just my kind of perspective. Someone like me who, doesn't own any multifamily units currently, like, to me, to make that kind of prediction, it would be almost foolish, right?
Yeah. And Indianapolis, the Midwest in general, it hasn't boomed like other parts of the country, and it rarely does, but it doesn't bust either. It stays much closer to the mean. And the average growth rate, for instance, in Indianapolis for the last 35 years is 2.9%. And that's the average. And we happen to think we can be better than average. That gives us some confidence. And it's been really vindicating in a way to watch, Yona, because I started this thing coming out of 2008 and getting, my butt handed to me at a young age, thinking I was a smart real estate operator when all I was a development cowboy, and had completely forgotten why I got into this game in the first place, which was for cash flow and then capital appreciation versus speculation.
Mm-hmm.
And the theory, this whole time, or the thesis has been, how do we build this and construct it in a way where we should do better in a recession? And we got our first big test, and we actually have higher occupancy and higher revenue in our current offering, our fund, our last several deals.
Wow.
Which has been really exciting in some ways. Certainly a lot of people are hurting, and I don't want to gloat about it, but for an investment manager, a fund manager, it's been really exciting to see the machine do better in a correction as we had always planned. And now it's not just a theory. Mm-hmm. We can show the proof in the pudding.
Yeah, that's phenomenal. And do you see that continuing over the next several months to a year, even if, for example, the Fed does not continue to support, giving those boosts of surplus money into the economy like they have been doing the past few months?
Well, frankly, if the Fed and other central banks around the world were to stop easing, stop printing money, stop buying financial assets, the world would be in the greatest depression we've ever seen. Like Japan, for the last couple decades at least, like the Euro zone, these major economies have to continue to quantitatively ease through various measures to fight deflation. And lucky for me, I was asked by an investor several years ago, what keeps me up at night? I get this question a lot. And my answer was deflation. until I learned more about what was going on at the central bank and treasuries and the equivalent government institutions in other countries, and realized that deflation or the deflationary boogeyman is what keeps up all the financial elite and all the bankers and all the central bankers. And so now that I know that, I no longer worry about the deflationary boogeyman as much as I used to, because I have the most powerful people in the world that are also concerned with it and have gone on record of saying that they will drop money from a helicopter in order to prevent it.
Mm-hmm.
And so for me, that plays very well into my investment thesis of buying tangible assets that throw off cash in locations where people want to live and have access to employment, good schools, and a few other boxes that have to be checked. All very simple, not easy to execute, difficult to find, but at a very high level, very, very simple when you get to the root of it.
Yeah, absolutely. And for someone like, say, one of our listeners, this is their first experience in this kind of a potential recession.
Yeah.
You know, you've lived through, and started out coming through that 2008 environment and planned accordingly now. But someone who is just experienced their first time, and I know there's tons of these, newbie syndicators. I mean, think about that Rod Khalifa event alone. There was like 600 people, and probably half of them were like wanting to do their first deal in the environment. What would you say to someone like that, to, advice or, kind of the stance to take?
That's tough. You, me and Neil Bauer were sitting at a table in Chicago. It's been a year, whatever it was. And I think maybe at that table or somewhere around there, Neil said, we're not in a real estate bubble yet, which I agree with, but we're in a syndicator bubble.
Yeah, I remember that. I remember that line.
Yeah. And there's just a lot more people that want to break into the business right now. And I think the ones that are trying to get in right now, who are going to be the leaders of the future, the top men and women in the space, are going to be the ones that learn how to start small, build a business around it, because syndication really is a business, and find a way to scale some sort of operating company, whether it's like what I did with management, which is very difficult, but very rewarding if you can stick with it and not quit, or some other play. I know some capital raisers now are forming their own funds, which I think is a much safer way to grow or scale a business than just being a quote unquote capital raiser, but going through having your own PPM, having your own marketing channels, and then investing with good operators. I think that's one possible road to success. There's going to be a lot of people that can't pull it off, right? And we're getting a lot of folks that are probably in it because they see a shiny object that looks easier than what they're currently doing. And it's like anything else.
Yeah.
20% of the people are going to make 80% of the profits, and maybe even more extreme than that.
Yeah, probably more. I would think even more extreme in this business.
Yeah, maybe 90-10 or even less. Track record really counts right now. So I would tell young syndicators, learn sales, learn persuasion, learn your craft, learn finance, and start in your own friends and family, your own backyard, your own network. Raising money online with people that don't know you, from Adam or Yona, is very difficult right now.
Yeah.
But if you can find people that know you and trust you, and you can start small and build a track record, you can rinse and repeat that. And if you're willing to put off the gratification of doing a huge deal, I think you're setting yourself up for more success.
That's great advice. And I mean, that phrase that Neil, put down there about the syndication bubble, I'd repeated that a number of times. And I just think it's unfortunate because, I think everyone who reads, Rich Dad, Poor Dad, or something of the like, or goes to one of these boot camps, is just inspired and wants to change, wants to kind of get out of the rat race and realizes.
But let's peel back a layer there on how Robert Key, he's one of my favorite authors, by the way. And I love his content. And I don't agree with everything he says,
right?
But I think Robert represents that path less taken, the poem, right?
Yeah.
And he's sort of the trailhead in the philosophy of that other path. I think if you peel back some of the layers there, Robert Kiyosaki, Grant Cardone, a host of others, you'll find a formula found in the cash flow quadrant where they took a B quadrant business and then they funneled into the I quadrant to buy lots of real estate. So Robert, for example, he didn't get wealthy just buying real estate, investing in real estate. He got wealthy by growing an education company, serving others, right? And then using that to buy more tangible assets that throw off cash. Grant Cardone, same thing. He didn't get rich in real estate. He got very successful at sales training platform and books and seminars and online classes and online training. And then he funneled that B quadrant income into the I quadrant.
Right.
I think people want to skip that step and they look at it as just a path to how do I buy a rental property a year or 2 rental properties a year. And that's not bad either. It's a good get rich, very, very slow plan. And that's better than nothing for a lot of families. But if you want to be really, really successful, true financial freedom, you have to learn how to grow some sort of platform, some sort of business.
Yeah, I hear that.
You have to learn the business of employees. You have to be able to figure all that out. And I wouldn't be anywhere close to owning 3,000 units if I first didn't grow a management company, which, by the way, I didn't syndicate a deal for a few years. I only managed other people's assets and started buying small deals myself with private hard money to learn the hard way how to renovate, right? And how to add value. And then I got a couple small deals with a partner or two. And then I syndicated my first big deal, which at the time was 60 units in 2014, I believe, and really started growing into larger assets from there. For me, I wouldn't have gotten that far without a management business first.
I hear. So the theme is repeating itself, clearly, to create a business, to do the work and reap the rewards of that work as that kind of follows suit. And I think that's challenging
realtors
enough.
Are a good example, right? There's a lot of realtors out there that want to give up the real estate game or the residential realtor game and just go buy apartments. It's like, wait a second, build out that residential real estate business with a team and with reoccurring revenue, then use that, but don't forget about that business.
I think part of the challenge in that is that in general, most businesses, don't succeed. And so people who are coming from other businesses not succeeding or other corporate, jobs or what have you, want to try to find a path of less resistance. And it sounds like you're saying it's just not feasible.
It's not businesses that fail all the time. I think it's people. If I can do it, anybody can. I was a C student at best. I didn't play a lot of high school sports. I was the weird kid doing taekwondo and climbing rocks. And I was pretty lazy. And I didn't really want to work that hard. And, I got into college and started really learning how to learn and got excited about real estate. Somehow got into business school. Back then, Indiana University would let anybody in. I think they took pity on my essay or something and got out. And I was reading Rich Dad, Poor Dad, and I wanted to be in real estate. I didn't know what I was doing. I didn't know all this about a business at the time, but I remember Rich Dad saying, get a sales job and learn how to sell. And finally woke up to the fact that this journey, it starts with just putting one foot in front of the other and just refusing to quit. And then realizing that I had to go from a solopreneur to an entrepreneur and learn how to hire people and manage people. And I just decided that it was going to be even harder than real estate and I was going to hate it. But that was the trial by fire that I had to go through if I wanted to grow anything of real size.
Yeah.
And I just refused to quit. And I got hit in the mouth a ton. I mean, property management of small rental properties sucks.
Yeah, especially if you're doing it in B, C locations where you were.
Yeah. Well, the trick in the beginning, if you're going to do property management, is only do B's and A's. You need residents that care about their credit because you can use that stick for collections. You don't want to take on too many C's in the beginning or you will literally go mad.
Unless you have a big stick or whatever.
But it was a stepping stone. I knew I had to go through that to get to where I wanted to go. We don't manage small stuff anymore, and we're approaching 100 employees.
Wow.
I've got a great operating partner. Partners is a big part of this thing, and we're exact opposites. And so together, though, we are greater than the sum of our parts. And finding those partnerships and growing a company is truly rewarding. It just takes a while in the beginning to get that momentum going. Good to Great calls it the great flywheel, or pushing a freight train. To get it going,
yeah. It takes a lot of energy at the beginning.
Incredible energy. But then once you get it going and you get it going long enough, that momentum takes on a life of its own. And now, we have this amazing culture and this amazing team of people that get so much of the credit for where we're at today, because they share in the same vision of a company where people are banging down our door to work here.
Wow.
And
that's great.
I get way too much credit for the execution of our real estate deals. It is not me, Yona. It is the team. It's my partner. It's the folks out here every day that are making me look good, from the grounds tech at the apartments, making sure that the trash is picked up daily, the property managers and their leasing teams, and the maintenance guys that are worth their weight in gold, that really, really drive this thing forward.
And that's incredible. And sounds like you have been thriving in this environment, which is such a positive sign that there's a lot of hope for businesses if it's done right. And obviously, you pick the right business to be able to weather those, all kinds of storms. But, I assume, like you said, you're growing close to 100 employees. That's incredible for no longer really a small business in that sense, that you've kind of grown.
You bring up a good point. I heard this quote a long time ago, and it's stuck with me ever since. And I've used this for our people. It's, guys, listen, we're not a small business. Even when we were 4 employees, we are not a small business. We are a big company that today happens to be small. And if you take that approach to how you reinvest in your company, the systems you set up, or the people you find to set up those systems for you, if you're constantly taking that approach, this beautiful thing happens, right? You become a big company, and you continue to grow because people buy into that, versus a small business where you're much more susceptible. There's this danger zone for solopreneurs becoming entrepreneurs, because if you just get a little bit bigger, you're very susceptible to losing key people, losing key clients, shifts in the marketplace. So it's sort of this approach that, hey, I'm not just going to go from 1 to 2. I'm going to go from 1 to 100 to 1,000, right? Because this middle ground here in business size can actually be a very dangerous place to stay. The death ground.
Is that just setting up systems? Is that setting up, key team players from the beginning to help that grow? Or?
People's the main thing. I mean, I got pretty far learning systems, but people is really the key ingredient in giving them the tools they need to succeed. Mm-hmm. And one of my biggest issues to overcome was being that lone wolf that could do everything better, right? And Tim Ferriss has got some great content on this, learning to let bad things happen, especially little bad things, letting people fall on their face, letting people make their own decisions, especially in their departments, letting them figure it out. It costs money,
yeah,
right? But that's just tuition. That all of a sudden, this beautiful thing happens. People take more leadership roles. They find people underneath them that can grow as leaders as well. And they're more accountable to their decisions than me saying, hey, I think we should do this, or I think we should do that. And that's, again, simple, not easy to accomplish, but quite simple. And the good news is it's like anything else. It's like a muscle. The more you work on it and strive to make it stronger through daily discipline and just doing the little things consistently, the stronger it becomes, to where now so much happens in our company: initiatives, decisions, ideas, our culture, our events for our employees without my input at all. And that's when it really gets fun to watch. It's almost like watching a person grow, right? It's like a proud dad when the company becomes an organism, takes on a culture and mindset of its own.
That's awesome. Well, you should be a very proud father, because it looks like you've grown something very special.
Thank you.
I want to jump right into the final four here, if that's right, Ivan.
Oh yeah, you got to cut me off, man. I could talk about this stuff all day. It's Monday morning. I'm all caffeinated. I'm talking to a guy I love talking to. Yeah, 4 questions.
Number 1, what was the worst job that you ever had?
There is no such thing as the worst job, but I'll pick one anyway. I think I've had a job since I was 7, working my dad's rental properties, mowing his lawns. That was pretty bad. I would say working the locker room at the local pool, having to be in the locker room and hand out the towels. That was a pretty terrible summer job.
Can't imagine that. Okay. For our listeners, we'll just leave out the visualization of that. Number 2.
Please do.
What is a book you've read or listened to that has given you a paradigm shift?
Oh man, I mean, there's a ton. Most of them we've all heard, right? The Rich Dads, the Think and Grow Riches, Good to Great. One that I think every investor should read is Anti-Fragile by Nassim Taleb, author of The Black Swan. Really helped me develop my thesis for doing better when things go wrong.
Incredible. Okay, we'll check that one out. Number 3.
Favorite of the last 10 years, for sure.
Okay, we'll definitely put that in the show notes, and anyone should go check that out. Number 3 is, what is a skill or talent that you'd like to learn?
Sailing.
Sailing. There aren't too many lakes, rivers in Indianapolis, are there?
We got a few. We could use some more.
Sailing. That sounds fun. I actually went sailing a few times when I was a kid. We had a little boat. My father, we went a few times, so that was fun. But it sounds exciting. Well, now you definitely have built the business enough to afford yourself a yacht, right? At that stage. So
I don't know about that yet, but I like renting boats.
Renting boats. Okay. So we're going to go to question number 4. Ivan, what does success mean to you?
So when I think about success, I think about health, obviously financial security, having a good spiritual relationship, getting high marks in both marriage and fatherhood. It doesn't matter how many zeros I have in the bank if all that other stuff I fail at. So it's got to be all those categories, high marks to truly be successful. And financial freedom is often said, and I agree, it's doing whatever you want, when you want, for as long as you want, with whomever you want. And that's what really keeps me going. And most of the time that's going to be travel with my wife and kids. We get a lot of fulfillment out of going and seeing places.
Oh, wow. Just on that note, where's one of the nicest or best places that you've been, spent some time in?
Oh my gosh. So I went to a conference down at the Breakers in West Palm, and my wife came down. That was a really, really cool place to visit. We're probably more though like national parks and nature. Mm-hmm. So we've got some little kids right now, but some big destinations is there just now. The youngest is going to be 5 in September. So we're getting back to that point where we can start traveling more. But I think our coolest vacation yet, definitely we took a couple of weeks in Europe, stayed with my brother who's in London, and then spent almost a week in the south of France in Nice.
Very nice.
Which was just a really, really awesome time.
Cool, very cool. And even now, still under these conditions and still the travel and restrictions and whatnot, national parks is still, it's still doable.
Yeah. If we weren't moving houses, I think we would have been in an RV and we'd be doing this from the road right now. Just get out of Indianapolis and head west.
Yeah, that's awesome.
I'd have you on my dashboard if I could, and we'd be driving somewhere.
That's really cool. You got to get the studio in the RV and look at you. That's awesome. Well, Ivan, I really appreciate your time. Thank you so much for joining us. Where can our listeners learn more about you or find you?
Oh, thank you, Yona. I'm pretty easy to find if you Google me, Ivan Barratt, but it's Barratt. Barratt. I've got an education series for high net worth and investors and families. ivanbarratt.com, barrattassetmanagement.com, 317-762-2625, 317-762-2625. That goes to my my personal assistant, and she'd be happy to get anyone on my calendar.
Awesome. Well, it's been a pleasure getting on your calendar today, Ivan. I appreciate it.
Right back at you, man.
We've been trying to get this one done for a couple of weeks now, so I'm glad we finally got it scheduled. And
me too.
You know, I hope people do check you out, because this is probably one of my favorite people in the multifamily space. And always a pleasure to meet you and to see you and spend time with you and talk to you. So wish you much success, continued growth. And, to all of our listeners, thank you again for joining us. And remember, the best advice comes only when you ask. Real quick, I have one question for you. Did you like this episode? If you did, I want to ask you a huge favor. See, the biggest thing that helps this podcast grow and that will spread this message to the whole world is that if you leave a review, a rating, and subscribe to the podcast. What that does is it basically tells the platforms that this podcast is out on is that you like my stuff and I'm doing something right. So take a few seconds out of your day, hit that subscribe button, leave a rating or review. I would be extremely grateful. Also, I want to hear from you guys. So I want to hear some feedback. If you have any questions for future episodes, please find me on LinkedIn. Send me a DM, a connection request, Yona Weiss, and I'd love to hear from you.